Aishwarya, thank you very much for your time. Last time I remember you had identified a theme of the kind of an unlock play for travel and tourism likely to pick up, and that was suitcases. As it's a small category, a bunch of stocks are there, but did pretty well. And I like the way you highlight and watch out for some sub themes in the broader market. Talk to us about what are you researching right now.
If you really look at the market, right, first thing I want to highlight here is that because basically the time has passed, we are actually passing the pandemic. Mostly we are at the peak of the monetary stimulus, the fiscal stimulus is behind us. So what we believe strongly is that we have to be very sure that where we will put investors should put their money. So the one point I want to highlight here is that easy money making is behind us, right? From here onward, money making will be difficult. One has to be very sure about which companies, which sectors, they will put their money on. That will create all the differences from here onwards. We believe investors should look out for a couple of trades. It's basically they should take the flight to safety from here onwards, right? So the area they should definitely focus upon would be a couple of them. First would be they have to assess whether the businesses that they are owning are benefiting out of COVID situation, whether those the COVID is acting as a blessing in disguise for these kind of companies, whether they've been able to grapple up the market shares, whether they are able to see higher revenue growth from here onwards. Second thing is obviously the scalability part, earning is very, very important from now onwards. So businesses which should grow higher in the earning trajectory for the next couple of years will be the one which will make money for the investors. And last but not the least, no point in guessing, is how strong is their balance sheets and the financials, which will help them to become bigger and bigger over a period of time. So we believe it's high time, for investors to go back to the drawing room and, chalk out a plan to see whether their portfolio is very strong and steady and they are into the quality names. Now, having spoken about this, we believe there are a couple of sectors, which are bound to grow much faster over the next couple of years and where investors can make a lot of money from here on. Obviously, one of the sector which we have been pretty upbeat about is chemical. We strongly believe that chemical will continue to see very strong growth from here onwards. Even on the global side, there could be a growth of 5 to 6%, but on India side, the volume itself and revenue could grow around 10% to 12%. And there are many companies which can grow around 20 to 25% PAT for the next couple of years. So chemical continues to be a very, very strong traction-based sector. Another would be I want to highlight would be IT sector. IT is one space. I can tell you the kind of digitization, the kind of deal pipeline which is building up over there, we haven't seen it in the last decade. We believe that the COVID has acted as a stimulus, where the whole demand for the next 5-6 years has been bridged down to over the next couple of years itself. So there's going to be huge traction, and we have witnessed that. If you look at the last 2 quarters, even this quarter, the quarter 4 and the quarter 1, most of the IT companies have reported very robust numbers, and deal pipeline in the commentary is of altogether a different stratosphere. Even most of the companies in US have reported likes of Cognizant and others have reported very, very strong numbers. So we believe the traction in IT will continue. And the third would be definitely the consumer discretionary. We believe that is one sector which can act and behave like a dark horse. This is one place where we will see huge amount of demand to pick up once we are out of COVID-3, possibly in a couple of quarters. And that will really, really make a big opportunity for high earning growth and good opportunity for investors to make money from there on.
Aishwarya, I also see in some of the schemes which you look at home improvement as a big theme across categories, be it high-end cutlery, be it the tiles and all those kind of allied products, be it other home improvement products. People are really taking a very closer look at upgrading their homes. Spending such a lot of time at home now in the last 2 years. What are your thoughts on the earnings trajectory of this category versus the valuations they are trading on?
Sure. So if you really look at the home improvement category have seen a big jump in the demand in the last year or so. So if you look at the businesses, the likes of say the leading players, if you just have a look at their numbers, say we talked about Kajaria Ceramics or Sera Sanitary Ware, which are the companies which we own in our portfolio. They were growing at 5-6% volume growth over the last say 5-6 years, and the trajectory has gone to altogether different level where now the growth has been pulled up to 20% or so. The kind of commentary this kind of management are giving is of a different what's the level altogether. And when you think about the reason for it, that there is a very strong demand, especially from tier 2, tier 3, tier 4 cities, and even in some part of the rural side because of a very strong support from the farm income over the last couple of years. We believe this demand will see a lot of traction, and also the larger and established players also getting a lot of benefit of the formalization and the consolidation which is happening in the industry today. The weaker player, the weaker franchise is finding it very difficult to sustain. So overall, we believe that this sector will also get a boost, because we have always seen that whenever there is a very strong equity rally, we can see that spillover effect on the real estate sector per se. So the home improvement, whether it is paints, whether it is your the likes of adhesive, your tiles, that segments is looking very very exciting from here onwards. And if you really look at on the valuation, obviously those stocks has moved up quite a lot in the last year or so, but they're still justifying the valuation from growth perspective. They were growing at 15-18% earning growth. That earning growth is going to go up almost close to 25 to 30% for the next 2 years. Then these companies are still trading at close to 1 to 1.4 time PEG ratio, depending on the different companies. And we believe that earning trajectory will continue to remain at that level, which will justify those valuations which is there. And last but not the least, I think the one other area which you highlighted about, the leading cutlery players and all that. As I mentioned earlier, that there is going to be possibly a very big jump in the discretionary space in the next 2 years, and that category itself is very very small. So we believe that not forget about earning, even the revenue trajectory would look very promising and impressive over the next 2 years in all the discretionary space right there. People have been, if you look at some section of the society, the saving rate has actually picked up. There's one startup which has been badly impacted by the COVID situation, but there is one section where the saving rate has moved up. If you look at the system at CASA in the economy has moved over the last 1 year, this money will find, will start following either real estate, will follow equity, will follow all those high-end consumer discretionary spend, and that is the reason we believe that this sector will do very well over the next 2 years.
Right. Very quickly, what are your thoughts on the mid-cap financials? I see some mid-cap banks and housing finance companies also. Do you think they are a good bet at this level?
Yeah, so mid-cap banks and NBFC are at a very interesting juncture right now. So what has been happening in the last year or so, there is so much of uncertainty which is there into the system, and the consolidation which has happened where the bigger bank have taken a lot of market shares, and the mid-cap banks and the mid-cap NBFC has basically focusing more on putting their house in order rather than focusing on growth, right? We strongly believe that there are a couple of good mid-cap banks and a couple of many good mid-cap NBFCs, which would really participate in the growth from here onwards, right? So we really like that housing piece, the housing NBFCs. I think we have very large allocations to the likes of housing players like Aavas Finance in our portfolio, or whether it is Canfin Homes, where we believe that those kind of good and clean players, which have a very strong liability franchise, the fintech way of lending, supported by very strong capital, and they have really done very well managing this COVID crisis so far. So going ahead, as housing is expected to pick up, supported by lower interest rate and the need for housing as the economy moves up, we believe this mid-size NBFC players, especially on the housing side, will really do well. Coming back on the banks, we believe it is another couple of quarters where we will really understand that how the COVID-2 has impacted, and what will be the likes of COVID-3 overall impact on this and banks, the smaller banks will be. But we believe there are a couple of small banks which have a very strong, capital position. The provisioning is very conservative, and they should be able to tide these tough waters. And then investors, will be very keen to go and grapple up those banking shares. Interestingly, these banks are now trading at, a couple of them are now trading at very, very attractive valuations. So investors can definitely have a look at that.
Right. All right, Aishwarya, we'll let you go on that one. Thanks so much for joining us with that take.